You can wake up in the morning and decide the glass is half empty, or you can decide the glass is half full. We went over a year without any tech IPO. We went about a year without any kind of meaningfully large strategic M&A. Cisco just bought Splunk. You had 3 companies go public at real scale, which are real business models. That to me is a glass half full.
Well, I am so excited for this. I think we have some of the best minds around this kind of virtual roundtable for this. I'm just going to start off by one, I just want to do like half a minute of introduction so everyone gets a scene and actually hears the voices. So Deven, let's start with you. Can you introduce yourself in 30 seconds?
Sure. Deven Parekh, Managing Director with Insight. Been at Insight since January of 2000. When I joined Insight, the market was rip-roaring. And about 4 months later, it was no longer rip-roaring. So I've kind of been through the current rodeo before. Insight is a kind of a global investor in software. We do everything from kind of early growth to buyout, and about $70 billion of assets under management. And happy to be here, Harry.
Amazing. Woody, over to you. 30 seconds. Hit me.
Yeah, Woody Marshall, a general partner at TCV. I joined TCV in the beginning of 2008, so the world was not rip roaring when I joined. TCV has been around for almost 29 years. We do 2 things: growth and technology, primarily software and consumer, and fintech. Just to give context, because there are lots of different definitions of growth. About 70% of the businesses that we invest in are at least 50 million of revenues, and about half are profitable. None. It's not a requirement. It just that's how it comes out to in the when you look at the data. But for us, we're focused on growth assets. There's a bunch of them that just may be profitable because of the the underlying leverage they have in the business. But that's what we've been doing, and that's what I've been doing for the better part of almost 30 years.
And Jason, I think for everyone that loves the roundtables, which everyone does, they probably know you, but hit us with your 30 seconds anyway.
Sure. Jason Lemkin. I run SaaStr, the largest global community for SaaS founders, and I've been seed investing for about 10 years. I'm pretty excited. I've got 3 or 4 after 10 years that I'm hoping will IPO at the end of next year. I've had some billion-dollar exits, one with Insight, hopefully one with TCV soon, but I haven't had an IPO yet. So I'm super excited to learn how great it's going to be at the back half of next year. And we've got some standing bets around this, by the way.
Back half of next year, Jason, it's happening. I heard from experts it's happening. Okay. So stay tuned for that. But I want to start, Woody and Deven. I'm going to hand this one on to you, which is everyone says that growth is just dead. Is this true? Are new deals getting done?
First of all, growth is not dead. Let's start with underlying growth in actual companies. If you look at Q2 of 2023, Insight had 180 portfolio companies that grew north of 50% in Q2 of 2023 over Q2 of 2022 in what are clearly a more macro challenged environment than we had maybe a few years ago. So the underlying growth in companies is still there. Now that's separate from where's the growth market as it relates to new investment. And like many people, our pace is down dramatically. We have done new deals this year, but many fewer than we did in 22, many fewer than we did in 21. The one thing I would just point out is if you look at 21 and 22, there was a lot of Series A and Series B investments that got done. And when a company gets funded Series A, Series B, and Jason can talk about this with more authority than me, you're not typically funding a company for 3 to 5 years. You're funding a company for 12 months, 18 months, 24 months, so kind of the next proof point. And so as we kind of get to the beginning of 24, you're going to naturally have companies that are going to need to raise capital. And some of them are going to have executed reasonably well, notwithstanding the environment. And what will happen is they'll raise capital. They just might not raise capital at the price they want to raise it at. I don't anticipate the growth market being dead. It's definitely the pace is going to be dramatically lower in 23. I don't know that we'll see 21 pace anytime soon or if ever. But I also think that, and this is one of the things we talk about internally, particularly when we're talking to the team, this market is probably closer to reality than 21 was. The pace of actually being able to spend time with companies, build relationships with management teams, take them out to dinner, see how they do over the course of 6 months, is really what this business always used to be. And I think is what this business will go back to being. And so I'm actually, while obviously we'll talk later about what happened in 21, I'm optimistic that we'll get to a reasonable place from a pace standpoint, because I still think there's a lot of really interesting companies out there that are growing.
Woody, how do you respond to it?
Devin's totally right. I mean, volumes are down. There's still a disconnect, kind of between buyers and sellers. So I would say you don't have the opportunistic fundraisers that certainly happened in 21, where somebody may have raised money and then another investor got excited about what that opportunity could be and bid them up 2x, 3x, 4x very quickly. So I think transactions are happening, but for very specific reasons. Maybe there's some strategic M&A. There's some specific growth investments that have been well thought through. By the way, today a company may have taken some debt, which was free before, and now it's actually expensive. So I think that there are some real business reasons that are driving transactions. You're also seeing some secondary. I mean, a lot of people haven't gotten much liquidity. Not that early investors are selling an entire stake, but provide some partial liquidity. You're seeing these things. I mean, look, we just did a deal with Deven's and the guys at Insight were in. It's a classic minority software investment, $100 million plus investment, $100 million plus business growing 50%, but losing a little bit of money, but very focused on a number of really thoughtful growth initiatives. Actually, there's ROI that's behind them. Like the team is thoughtfully allocating incremental capital. So they're definitely happening. And to Devin's point, I think you're seeing companies that are executing well. The issue is you need a reason to want to raise money today, because there is that valuation disconnect. And there's a lot of investors that, they're trying to buy, $1 for 75 cents. They look at the public market and think that there's a great deal there. I just don't think those transactions are happening. And I agree with Deven that I like the more normalized pace, just because, investors get to do their work. Management teams get to understand the investors that they're getting involved with. And I just think you end up with, better decisions and more commonality on kind of shared, vision and execution, after a transaction gets done.
Is that for folks that maybe haven't been in the venture markets before 2020, is 6 months a reasonable way to think about pacing for a growth round? Do you guys like to see 2 quarters and get to know folks? I don't. And what was it at 2021? How fast did a deal get done in 2021?
There's an earlier round. I mean, I think it always depends. I mean, sometimes an earlier round can fund a company for 2 years.
No, to get to know you guys, to get to know you, to go from first meeting.
I don't think there's a magic.
By
the way, I don't think there's a magic to 6 months.
No, but I thought it was just an interesting anecdote, right?
I would say the other interesting thing is, like, we have a bunch of companies in our portfolio, companies that we like, and I think what we have been positively surprised by. We've got one literally that we just got a term sheet today. I wasn't really even expecting a term sheet, but we got a term sheet from a firm that I've never really seen before. That showed up with a pretty attractive term sheet, and we're going to participate in the round. Companies actually doing well. So I think that companies that are executing well, that have reasonable expectations of value, are really able to raise capital today. The one other thing I just point out is there is another driver of why rounds are not happening, which is that companies were smart. That when the cost of capital was low and valuations were very high, many of them went out and raised a lot of money. Right? We have multiple companies in our portfolio that have between $300 and $500 million of cash on their balance sheet, and their last round could not replicate today, and they actually kind of know that. But the news flash is they don't need to replicate it because they took advantage of that time and raised a lot of capital. And so the other reason is, and I think Woody touched on this, is that's not a deal where you're going to get an easy clearing price because the company has no motivation or need to raise that capital.
Deven, are you not worried that they're going to have such a valuation scale into? I have some companies, not quite with 300 to 500, but we'd say 100 million. But to get that 100, they did it at 100x ARR. And I'm sitting there going, God, that is a big valuation scale into. Do you share that worry? And how do you think about it?
look, I think there's two different constituencies that I worry about in that case. Obviously, I worry about myself, right? Because I might have written a check,
or two.
but probably more importantly, I actually worry about making sure that the team is incented, right? And so I think there's going to be a lot of those cases where companies, with our support, we're going to significantly reduce the valuation of the option and equity incentives going forward. Part of a lot of those rounds, obviously, is investors are sitting in preferred stock, not in all cases, but in most cases. And so they have downside protection that the employees don't have. And I think what is going to be important is because these companies are really not worth much if you don't have a team that's motivated. And so I think that there will have to be a realignment, Harry, around how we create equity incentives for the team in these companies. But for investors, it's going to take longer. So a deal that you might have thought might take 3 or 4 years might take 5, 6, or 7 years. And maybe at 5 or 6 years, you might only get your money back. And it might be that in a place where I get my money back or a late stage investor gets their money back, employees still really need to earn money, right? Because still a lot of value creation needs to happen to get there. I think there's multiple constituencies and we just have to be sensitive to all.
Are a load of teams just going to get wiped out though on the pref stack side?
I'll let Woody answer that one.
The only thing that's going to determine ultimate valuation for any of these situations is the performance of a company. And Deven's 100% right. Like, companies don't run themselves. There's always these discussions about so-and-so raised a lower priced round, or the 409A, to what Deven was talking about. 409A is so much lower, and it's written about in the press as like this bad thing, and like, look at this stupid company. And to me, I have the totally opposite view, which is, here's a company that is, by the way, if you're a public company, there's no argument, right? Like, your stock was trading at 100 and now it's trading at 25. Like, there is nothing to argue about. On a private company, the smart companies are, resetting the deck. They're ripping the Band-Aid off, because the problem with companies that hold on to some of those valuations is they're going to make decisions that are suboptimal when you think about how to build the business over the long term. And as an investor, by the way, we take that risk. And Deven's right. Like, if you look at the things we invested in 21, we like those companies a lot. It's going to take us longer to get our returns. It just is, because multiples have come down. But if you don't have a company that level sets to where they are, you're not going to have motivated employees, and you may make decisions that are not the right decisions for the organization. Shoot the moon. By the way, the only way we're going to be worth anything is we have to literally put everything in. Like, I'm all in on black, as opposed to thinking about how should you most efficiently allocate capital given the environment that you're in today.
The one thing I'd add, which you didn't ask, so you didn't ask the question, but I'm going to answer the question you didn't ask, which is, where you have companies where they're trying to hold on to that last valuation, forget now from an employee standpoint, but because they think it's better to go to their employees and say our valuation's flat, when everybody, including the employees, know it's not. And then they go out and try to raise some heavily structured security in order to try to kind of preserve value. And I actually think that's the most dangerous thing the company can do, because then you do create a challenge, because you create an artificially high valuation that's not consistent with where current values are. It makes it harder to actually strike the 409A valuations where they probably should be struck. And you're also not just being intellectually honest. Like, in a public company, when Facebook stock goes down, they take action, the stock goes up. You just don't get to do that in a public company. But when you start thinking that your company's worth something, look, Instacart's an example. That valuation came down a lot. The 409A valuation came down a lot. Now it's a public company. It'll end up trading over the next few years based on its underlying operating performance.
Can I ask a question about that, about structured terms? Everyone on the internet talks about how toxic structured terms are, right? Are they so bad? Imagine Harry and I are running a startup together. We're at 50 million in ARR. Okay, we're growing 80%, pretty good, right? And we raised the last round at $1 billion. Okay, not at 5 billion or 50 billion. And we got someone that'll do a round extension at $1 billion. But they want to get a guaranteed 2x return. Okay, I get that it's debt-like. But Harry and I want the money. We get it, and Harry and I are in it for 10 years. We're going to IPO. We're going to get to 3, 4, 5 billion. Why is a little structure? Box had it when it IPO'd, other had it. Why is a little structure so bad? I'm not sure bridging the difference is the end of the world, is it?
It's great when the outcome works. right?
Yeah,
Like,
but we're going for it. We're all going for it.
Right.
The four of us are going. We're going
so
for these big outcomes. It's just a challenge to learn that if it is it always so bad, right? A little structure.
When you go to the casino and you bet on red and red wins, it's great. It's just when you bet all on black and it goes red, it's not great.
It's the same as preference, right? When things work out, you could have invested in common as opposed to preference. The only time preference actually comes into play when it doesn't work. But by the way, this is a decision that, the issuer has to make, you as the company. We don't like it because we like to be on the same side of the table. And I just think all of a sudden you have, differing motivations. Heads, I win. Tails, you lose. Like, we should all benefit as the value of a company is created. I also think there's, from the investor standpoint, there can be the fallacy of, oh, look, this is a really interesting, opportunity because of the structure. Structure never made a good company, right? Like, at the end of the day,
no, it doesn't make a great company.
Find
right?
a good company,
it can't make a great company.
and pay the right price.
Yeah.
I understand why people do it, because sometimes adjusting a price creates a crescendo of other things that happen, anti-dilution, a bunch of other things. But in a perfect world, I'd rather everybody being on the same side of the table, where just driving enterprise value benefits everybody, as opposed to, differing outcomes depending on, what security you own.
But Jason, let me ask the question of why I would care in that situation.
Yeah, why? Because every VC at every level, from pre-seed to crossover, has a bias, right? Every bit of advice from including all four of us. So I just want to penetrate the bias.
I'll tell you why
right?
I would care in the situation you said, right? Because the $50 million ARR company is growing 80%, and
Harry and I are feeling pretty good.
You're feeling pretty good.
Yeah.
But the odds are that you're not going public. Like, the 75% probabilities you're not going public. If you end up with a structure that says the structure only converts at $2 billion, when Cisco comes along, or IBM comes along, or name whoever strategic you want comes along and says, hey, here's $1.4 billion. And again, I'm making up these numbers. Here's $1.4 billion for the company, and that's, by the way, 17 times trailing revenue. And the founders are sitting there going, well, I'm not going to do that deal because I got to wait for my 2x conversion, because that's the only reason I took that money. We're not totally misaligned on what could have been a good exit for me and you, but you only want to happen if the deal structure. I've been in that exact situation.
It's a good point.
I like alignment. Now, am I telling you that there's? What I'm not saying is two things. One, I'm not saying that we don't have any companies that have it, and B, I'm not telling you that we've never done a deal that has it. But the deals that I've done that has it, I've almost always preferred in the end that I didn't have it. Because structure ends up trying to bridge a valuation gap at the end of the day. My view is, at this point, I'd rather just either get to a deal that I'm comfortable with or not. And if somebody else is willing to do it with structure, I'd probably rather just let that other person do the deal.
Well, that might be the insight right there, right? You'd rather let someone else do the deal.
Because of the conflict. I want, Jason, when that bid comes in from a strategic, I want you and I thinking about it exactly the same way, not different.
Can I ask you, we said about a realistic resetting of valuations and like incentive alignment. If we did that across portfolios, venture investors would be resetting in some cases 50% down, or marking down portfolios really across the board, 50 to 60% in some cases, if we want to be direct. That's not in their interests often with LPs who they want to go and fundraise from in the next quarter or 2 quarters or 3 quarters. And we've seen delays in VCs marking down their books. Is there an incentive misalignment in the resetting of valuations in that respect?
Yeah, that is an issue, right? That is an issue. And if you talk to LPs, there are many of them that are waiting. You can have many different investors in the same company, holding a particular security or a particular company at different prices. It's definitely an issue. But fundamentally, again, you want everybody to try to get to the point of this is a fair price, because the decision issues that Deven talked about, until you're all on the same side of the table, somebody may be fighting for something that is not the right optimal outcome, but it's the right thing for them in the short term. And that's a bad thing over the long term. So I think LPs are trying to get smarter. I think anybody, if you're a firm as big as mine or as Deven's, there's a very a sophisticated process that gets reviewed by auditors, which is a little different than, with a lot of the early stage guys. So it's hard for us to play around with valuation. And I just think that needs to flow through to, everybody in the, in the investor community, or you have all of these different opinions that have different motivations, given their valuation discrepancies.
Totally get you. Can I ask, Jason's hypothetical example mentioned, the 50 million ARR company. There's a large group of SaaS companies at 100 million, even 200 million ARR with decent-ish growth. Will PE activity pick up here? And what happens to them?
I think you're going to see, and we've done a bunch of these deals. Others will have done some of these deals. I mean, those are going to be companies, they're not all perfect public candidates, but some of them are not necessarily perfect strategic candidates either, meaning there's not a logical strategic who wants to own the asset for whatever set of reasons. And I think you're going to see firms those firms can get bought by sponsors or firms like us. And I think there will be a market for those types of assets. And I think the challenge is going to be, in my view, is those assets that are not growing that fast. And the lower left quadrant is crappy growth, high burn. Okay. Like if you've got crappy growth, high burn, like
no need to email.
Yeah.
Don't box you don't want to be in.
Right. I would really request you send your pitch to Woody. But I'm teasing. But I think that the companies that have, just like you're seeing in the public markets, what you're seeing in the public markets is so if you go back to 2020, the correlation to revenue multiple in the public markets was something like 72% was correlated to revenue growth. Today, it's in the mid-30s. What's the spread? Well, path to profitability or free cash flow. And everyone's kind of reset. Now, it's not like Woody has to show up at the board meeting and tell his CEO, yeah, you really should be more profitable if you want to go public. Because all he has to do, or she has to do, is look at the public comps and look at what the research says. I think that there's going to be absolutely a market, Harry, for companies of good revenue scale that have got reasonable growth that can kind of build a rule of 40 company.
Are you guys modeling that this efficient market, where that correlation for revenue versus profitability, are you modeling that's going to be true in 2025, 2026? And I haven't done the homework. My gut is that historically, that's been a minority of years in tech, right? Most years we've been valued on, and you guys don't have to think 20 years out, but are you really still do you want to value it the way it is today, or where your gut is it's going to be in 2024, 25, 26?
Well, when we did deals in 2021, I'm talking now about revenue growth driven deals, right? As opposed to buyouts or more EBITDA driven. We do both. We were assuming on average 50% multiple contraction. Now, at the trough, they contracted even more than 50%, and now they kind of come back to, close to 50%. If you look at long-term software multiples, like over 15 years, today's multiples are lower than like the 15-year median, but not by 40%, right?
So maybe 15, 20%,
maybe 15
right?
or 20%, right? So I actually think there's upside, personal opinion, but I think there's upside from today's revenue multiples. But I certainly wouldn't think that we're going back to 21's multiples either, right? That's a different environment.
Yeah, and I also think over time, there is as businesses grow and they, may slow, and there's the rule of 40. These are these rules of thumb. And I was talking to some capital markets folks recently that were talking about, 2 years ago, if you had talked to the public market and you ask them, the combination of revenue growth plus EBITDA margin is your rule of, analysis. And what was, if you wanted to get to rule of 40, that's special company, what were the characterizations? What were the component parts? It used to be 60 to 70% growth with the negative 20 to negative 30% EBITDA. Today, depending on who you talk to, it's like 30 and 10, 20 and 20. Like they want to see both. Devin's 100% right. When you're in the growth world, the multiples that you enter in are very different than the multiples that you underwrite your exit on. And that's just the nature of the deceleration of the business as they scale. The other thing is revenue multiple may be an output, but it's not the metric. The metric might be, here's your EBITDA multiple. take a look over time, things will start to trade at EBITDA, or they'll trade at, maybe it's gross profit for a little bit, then it goes to EBITDA. And over time, it's going to get to net income. At the end of the day, we were Facebook investors when it was private and the thing was growing like a weed. By the way, it was very profitable, but read every Facebook report that comes out. Nobody talks about revenue. Some people may talk about EBITDA, but it's net income. That's the evolution of these businesses. And I think you have to figure out in your hold period, 5 years, where are you? Are you a 20% revenue growth business? Are you still 50, wherever you are? Because that's, I think, a little bit of where you're going to be on the valuation continuum, especially with the metric that is most relevant to investors.
Hey, Jason, when I was in high school, I remember going up to an Ivy League admissions officer my junior year of high school and saying, hey, am I better off taking an honors class and getting a B or a regular class and getting an A? And they looked at me and said, well, if you want to come to our school, you got to take an honors class and get an A. So it's not a choice.
It's not a choice, though. Just for I think many founders and others are confused about some of the messaging around efficiency today, right? And maybe a different way, since we have two great growth investors, is will you guys, because there are macro impacts still, we're not over these macro impacts, will you take a lower growth rate with an asterisk and dagger and assume it will reaccelerate if we have a very efficient model, right? Will you settle for a slightly lower growth rate today than maybe 2 or 3 years ago because of macros? Or is there no credit for it? Is it the Harvard AP biology?
Jason, I think the problem is it's very hard to, I'm speaking for myself, I think it's kind of very hard to generalize the answer, right? Because take a consumer growth company, right? I think there's lots of examples, and TCV has examples, and I'm sure we have examples, where you got a consumer growth company whose growth rate was really just driven by like a payback period that just didn't make any sense. And if you say, okay, I'm going to change my payback period, I'm making up numbers from 24 months to 18 months or 12 months based on kind of the gross margin and what my ad costs are, that growth is going to slow down. And it might not reaccelerate. You were just acquiring customers that were not going to long-term be profitable. Now, that's one example. Another example might be kind of an enterprise software company whose customer acquisition costs got really expensive because they bought too many seats during COVID and they overbought. But the fundamental macro of that market for the next 10 years is great. They just got an overbought period. So you cut some expense, but then that business will probably reaccelerate once they get over the hump, right? So I think the problem is people always want like the easy, here's the one rule and just follow this rule. Kind of depends on your business model, depends on kind of what's changing about your income statement, what affected your growth rate. I mean, I guess if it was an easy rule, none of us would be making much money doing this. And so I think it is a little bit dependent on the business model.
We spend a lot of time on product, right? Understanding where the product is, understanding how the customers are excited about the product. Deven mentioned one of the things that you certainly have seen, which is folks overbought. So understanding what the core value of a product is, what should the pacing of a customer relationship look like? There's all of the metrics of gross retention and net retention, which are really important. But if you think about one of the things that drives net retention, obviously besides gross retention, net retention is what are some of the other products and features that you can add to the customer? And, to me, the thing that we spend time on is if you are really embedded in a customer, and by the way, this is whether you're talking about a consumer or whether you're talking about a small business or an enterprise. Are you valued enough because of what you provide, that cost value proposition? You're in a really strategic position. So as you build more functionality, you have a right to win that versus someone else. The magical companies are the ones that when you're, 3 years into your hold or more, the opportunities that you're talking about or product initiatives that weren't even being discussed when you made the investment. And that's companies that are really, really focused on innovation and iteration. There is no math problem that can do that. This is to Deven's point that that's the thing that you really have to understand. What is the opportunity? What are the problems that the end customer has? What are the solutions? And why is the company that you're getting excited about, why can they take advantage of that opportunity over the long term? And some of it, may be a numbers issue, but it all, I think, the inputs that are most important are tell me how good the product is and how can it be extensible over time, given your position with the customer.
We've spoken about revenue multiples quite a lot. I do have to ask, Jason said to me before about how he kind of bluntly believes in the broken nature of kind of SaaS venture investing, and I'm probably butchering this, Jason, so do correct me if I'm wrong. But if we assume that, 6x ARR is kind of the trading price for a public SaaS company today, Jason thought that maybe, is that really high enough to sustain a true growth market? How do we feel about that if 6x is the new normal and not just an adverse time?
I mean, look, I think Klaviyo is trading at 8 times forward, growing at 50% with, I think profitable. Shopify concentration, maybe that's an offset. But look, if 50% growth with great economics are 8 times forward, there's a lot of companies that have less good economics.
A lot.
So I think I don't know that, Harry, that it's an easy answer to the question. But I would say this, and I think Woody would agree with this, but I think the least active part of the growth stage market is late stage growth. And I'm defining late stage growth as what used to be called pre-IPO, or however you want to define it, right? I'm going public within a year. Because I think, frankly, it's the least clear of how you underwrite your return, right? Because those companies are looking for valuations that in some cases are north of the public comps. Now, it's very different when you're investing in a $20 million revenue company or a $15 million revenue company. You're making a different bet. You're making a bet that's 4 or 5 years out. Your revenue multiple assumption is more based on how fast can you kind of grow over that period of time. Totally different for Harry, what Harry you do and what Jason does. Like, that doesn't really matter in my view where Klaviyo is trading. So I think the market that's the most stuck right now is that late stage growth, and is probably where you see the least amount of deals announced. Databricks would be the one exception of a big late stage deal that's gotten done recently.
Okay, so if there's the least activity there, Deven, I'm proving a bet to Jason here, so I've got a lot of money on the table. But if the least active area is that late stage growth, does that not mean that we're going to see a further delayed IPO window opening? Jason thinks it's H2 2024. I'm saying with the, as you said, kind of frozen nature of late stage growth, it's going to be H2 25.
No, I would probably, well, who knows? Let me start by saying, since the chairman of the Fed can't predict the economy, I'm certainly not going to try. But I'm probably a little bit more optimistic. I'm probably closer to Jason, kind of back half of 24. I don't think the activity in the late stage market is necessarily a driver. You pointed out correctly earlier that there's tons of software companies with $100 or $200 million of revenues. Some subset of those are potential public companies. We have some of those. And there's no need for them to do a late stage round to go public. It used to be that people would do these rounds just to kind of get a third party validation of value. Let's take Instacart as an example. What would have been the value for them to do a late stage round before they went public, just so that they could tell their employees, yes, let's definitively tell you that we're worth less than our last round? No, the public market became the late stage round. And so I think that that's really what you're going to see. I think you're going to see companies that have a good economic model, that have the predictability that the public markets crave, that have got the balance between revenue and path to profitability or profitability. And the public market's going to determine what they are willing to pay for that. And over a 3 to 5 year period, they'll trade based on the underlying economic value that they can drive, which is kind of the way markets should work. So I don't really see a relationship between a slowdown in the late stage market and the IPO market. I think they're kind of right now disconnected.
Yeah, I look at it as that's going to be up to the companies. If you look at the 3 IPOs that happened, I believe they all sold less than 10%, right? So that's a small percentage. What they were doing was, we refer to it as putting the puck on the ice.
Yeah.
The only thing that's going to determine ultimate valuation is your execution. So you know what? I know that the press loves to write about like IPO price compared to last price and everything. It doesn't matter. It literally doesn't matter. And by the way, it matters less when you sell 6 or 8% of your company versus something else. Put the ball in play. You give your shareholders, if early shareholders need to get some liquidity, great. Put the ball in play. Reasonable price over time. The long-term, public managers will find the best positioned businesses. We'll build positions over time. I think it's only goodness. And you're betting on yourself in the sense that you're like, hey, I know I can execute. I can grow my business at 20%, a year for the next 5 years, or, maybe my profits will grow faster. And, that's one of the things that the markets are interested in. And there's benefits for me being public maybe I want to do some M&A. It provides liquidity for shareholders and employees. So to me, I actually think the markets are open, but people have to, you have to rip the Band-Aid off and not be wed to, but in 2021, I was valued at X. That doesn't matter. If you're a public company today, that's in the rearview mirror. The public companies that do that same analysis, rip the Band-Aid off, they can go public if they want to today.
Can I ask a related question? Just curious. You guys, neither of you did the last round. I mean, I'm a super fan of Klaviyo for many years, right? And Andrew's great. Neither of you did the last round, right?
We're not in it.
So the last round, I think, was at $9.5 billion. I didn't look up the S1, but let's assume it's trading slightly down for purposes. Yeah. Behind the scenes at the late stage investors, what are they talking about? Have they already adjusted it? Is there stress around it being slightly down? Just tell us, because I just don't have that visibility about what those conversations happen behind closed doors at the late stage.
There shouldn't be.
Yeah.
I mean, it's not a surprise.
It's not a surprise, right?
Take a look at the public market since the Q4 of 2021.
Yeah, what I'd say, Jason, is that I think, unfortunately, off the top of my head, I don't remember who the late stage investors are in Klaviyo, but let me make a slightly different point.
I think Summit did the one before and like 40%.
Summit
they did okay, right?
Summit made like 7 times their money, so they're just fine. But I think that if you look at, we have like, say, 2 companies right now that I know of that are looking at doing kind of a late stage round sometime at the end of this year. But here's why they're looking at doing it. They're looking at doing it because in both cases, companies have executed unbelievably over a very long period of time. They are both have a very clear path to real margins. Neither management team has really ever taken any meaningful liquidity at all over a very long period of time. And they're kind of looking to do a round to provide some liquidity pre an IPO, because I think they want to, we're also in a market where investors or management teams selling into an IPO is a challenge, right? It's not what people want to see. The most likely investors that are already talking to them are the same people who are going to buy stock if the companies go public in the public markets, meaning some of the mutual funds, as an example. Why is that? Well, Woody made the point about these offerings are getting very small. So if you are a growth manager, you actually need growth product over time, right? Like, you're not a value manager, you're a growth manager. You need to find growth stocks to buy. And when there's so little inventory and the amount they're selling is so small, and the size of a Fidelity or a Vanguard or a Wellington fund is so big, their ability to buy a position in the public market is actually not that, they can't get much allocation. So these actually even become ways for them to build a position in a company that they want to probably hold for 5 or 10 years. Now that might be separate from a hedge fund that might want to flip it in a week. That's probably not who you want in your late stage round either, right? So again, I don't know the specific answer on Klaviyo because I don't know who it is, but I think the people who are looking at these right now are looking at these in a rational way. They're not expecting to make a massive return to IPO. They're kind of building a position in a company they're probably going to stick.
Is there angst for, and again, maybe if it was either of you, then censor me, but if you did the Instacart round at 38 or 39, whatever it was, right? What happens behind the scenes? Have you already marked it down so long ago that no one cares? Do you just fire the partner that worked on the deal? I mean, you think I'm kidding, but in my limited experience in venture, I've seen folks kind of get shown the door on deals, right? What happens behind I mean, it's a wildly successful company, Instacart, right?
Yeah,
but it is worth a lot less than 38 or whatever
thankfully,
it was.
I don't think either Woody or I are in either one of the deals you're talking about.
What happens in those partner meetings when Harry or Jason we did the deal, Harry and Jason together, we split the deal.
But we're in a risk business. If all of a sudden you start smacking people on the hand if they make a mistake in a risk business, what are you going to end up with? Well, you're going to end up with a risk-averse set of investors, and you're guaranteed your next fund is going to be like a 1.6x. That's not exciting.
Yeah, that makes sense.
Yeah, obviously, if somebody, I guess, did it 20 times, like at some point, but I think that I don't think anybody's going to escape 21 without having made mistakes, right?
For sure,
I don't think any investor, no matter who they are, no matter what their reputation was, no matter where they are on the Midas list or some other list, they've made mistakes. Woody's made them. I've made them. But I would tell you that the ones that we made in 21, a lot of them are marked down substantially. So if they did a follow-on round or they went public, it's not going to be a surprise.
Got it.
Probably going to
it's all been internalized at this point, right?
Yeah. Like I can't speak to the specific company that you're talking about, but I'm just talking about, at least with us.
This is the point, Jason. It should have been, right?
Yeah.
Should have been, yeah.
And if, yes, there are people that may, be living, in the past saying, well, company's still doing well. Why would we change the multiples? I'm just look at the public markets. Anybody that has a methodical valuation process, things are marked to market, or as much to market as the private market can be.
I had dinner last night with a manager who manages close to $1 trillion, one of the largest asset managers in the world. And he said, I looked at the 3 IPOs, Harry, and you won't get it, young one, but this is not good. These were not good IPOs, and I'm not optimistic when I think about this as the opening again.
That they're all flat, basically? Was that the concern?
They're all flat. There were no big buyers in the books. No one was stepping up going, oh, I'm excited. I want to buy 10%. It was widely distributed amongst the institutional buyers. And then performance post has been lackluster. Do you think that's fair? And do you share that?
I don't. Look, when you have small offerings like that, small changes in volume can have massive impacts. What's happened since all those guys went public? You had the Fed comments. I think the 10 years now over 4.5%. I think a lot of it's macro. I guarantee you, and I'm not a trader or anything, but I guarantee you that the short interest is probably off the charts on every one of those. So I wouldn't say at all that the stock performance is indicative of the underlying companies, but as much about trading volumes and how certain people are approaching them. Those opportunities, small float. You're going to have lockup releases in the future. Well, it's a short against those distributions in the future. So I understand the comment. You have to start somewhere, and I personally think, let's see how the companies report. I would expect that the companies will have been thoughtful about this, and they will continue to report solid numbers. But the fundamentals again is valuation is only determined by your performance, and going public in a market like this, you're betting on yourself. Yeah, it'd be great when there's more volume and more liquidity, but I don't look at this as a failure. I think you may not have as many people that are lining up to do this because I think everybody thought maybe all the stocks would shoot up by 40%, and then and then there'd be a line out the door. It's just going to be a little bit harder, and I think the macro is a consideration here.
Yeah, I also say, Harry, look, you can wake up in the morning and decide the glass is half empty, or you can decide the glass is half full. We went over a year without any tech IPO. We went about a year without any kind of meaningfully large strategic M&A. And we went through 12 months where every infrastructure software company was talking about cloud optimization, which was driving down their volumes. If you look at the last quarter, that's kind of bottomed and start moving in the right direction. Cisco just bought Splunk. You had 3 companies go public at real scale, which are real business models, not companies that don't have business models. These are companies that are profitable, good companies. Maybe Instacart's not there yet, but it's on the path to getting there. And so, look, I look up and say that to me is a glass half full. But if somebody wants to wake up and say it's a glass half empty, that's their prerogative. But I actually look at it much more like Woody does.
Jason, how do you look at it?
I don't know the answer. My question to the group is this. For the sake of the larger, this is sort of the flip side of the Bill Gurley point about direct listings and efficient pricing. What if Klaviyo had decided to IPO? I'm just looking today. Klaviyo's at 36, okay? Yeah. Going to Devin's point, there's nothing to knock Klaviyo other than the Shopify dependency, okay? Maybe a few other things. It doesn't get much better, folks, than 600 million growing 60%, profitable with almost 120% NRR from SMBs. I mean, you can't find a better company, but I think it was priced to perfection the round, or priced to optimization. Should it have IPO'd at 25? A company leaves a bunch of money on the table or takes some dilution, not cool, but the market's restarted, right? Should you take one for the team is the question, because if everyone made 40% on Klaviyo, would people be rushing for another 30 or 40 SaaS IPOs?
Maybe, but
Maybe.
but you made the right point, because if it had that happened, we would have 5 articles about the billions of dollars that were left on the table by Klaviyo shareholders. There'd be 4 editorials about the IPO market's a scam, right? So
but would it be better as growth investors? Would it be better for you guys? Because would it help the rest of your portfolio of create liquidity in the market, right?
When other companies leave money on the table and have great aftermarket performance, I'm not complaining, if that's your question.
Sort of.
Because sure, that creates more sizzle, and institutional investors, mutual funds, and others who are buyers are sitting on a portfolio that's up, which gives them more confidence to buy the next issue. But at the same time, you have to expect that companies are going to try to be reasonable about their pricing. But I also think, don't underestimate Woody's point. There's a lot of macro uncertainty, even over the weeks that these deals were getting done. In a different world, that level of macro uncertainty, these deals wouldn't have gotten done at all.
For sure. Yeah.
You're going to go public, it's going to be volatile, but I'll still stick to my point, which is ignore the noise, focus on your business. The only thing that's going to determine your ultimate valuation, which, by the way, if you're a long-term investor like Deven or myself, that's what you're waiting for. Ignore that volatility. The only thing that's going to determine the ultimate valuation is how you perform. You put the puck on the ice, you're going to start, being able to, what the public market wants. Oh, Harry's the new CEO. Let's see how he does against his guidance. Does he understand his business? Does he communicate it well? Start the process.
Woody, you said ignore the noise. One thing I do have to ask is, late stage market's pretty frothy for AI deals. How do you think about the late stage frothy market for AI deals?
Well, if you step back, this is a remarkably fundamental trend that's going to have significant impacts. We have not made any AI specific investments, although I would say 100% of our companies are leveraging AI in lots of different ways, whether it's how you touch the end customer or how you make some of your processes more efficient. This is the positives and negatives of the business that we're in. There are going to be, we can say it's a frothy market and this is crazy. People are going to lose their money. There are going to be some of the bets that are made today that, we'll all look back on and say, God, we should have known that. It was, AI was, at the beginning. Why didn't we put our money in there? We could have made, X return. That's not an area that we have made any direct investments in. It is a good reminder that the reason that people get excited about technology is it can have remarkably fundamental impacts on consumers and businesses alike.
Deven, how do you think about it?
So, we have been active in AI, but ironic. So if you look at Fund 12, our most recent fund, I think about 7 or 8% of it is invested in AI companies. Ironically, almost zero of it was invested in 2023. Almost all of it was invested in 2021 in more AI infrastructure companies as opposed to the LLMs. And it might be the one category where pricing in 21 was better than the pricing in 23. It might be the only category where that's
a good quote.
So I think that, and like Woody, almost every portfolio company is implementing it within their portfolio. Look, we think right now in 23, the valuation, we're in a hype cycle. The valuations are way ahead of where companies are, and you're seeing companies who've raised money as recently as 6 or 9 months ago who are already being impacted by something developed 6 months later. While we're spending a ton of time on it and we're getting smart on the space, we're being cautious this year, just given where valuations are.
Jason, do you have any final questions before we do a bet?
A final question. Can I ask a real life example for fun? Do we have a minute? Kind of a grounded in the state of the growth. And I know Deven's like, you can't give me specific answers on specifics, but I literally had a board meeting this week. Here's a question about efficiency today. SaaS startup, SMB, over 100% NRR from SMB, so pretty good. 50, 50, 0. 50 million ARR, 50% growth, no burn. Okay, but not 100% growth, not 90, not. Is that growth fundable? What's it worth? Can you give us? I know you don't want to, but can you tell us, is it fundable for growth?
Yes, fundable.
And what's the most it would be worth if it's not AI? What's a 50-50 0 worth in today's world?
Again, I go back to what Deven said before. The numbers are one thing. The specifics around, what the market a company's in, what the end
Assume
customer.
you like the company, though, for the sake of assume you like it. There's some macro impacts. You could argue it could be 50, 80, 0, right?
It's certainly probably worth the Klaviyo multiple, right?
Well, that's an interesting insight. Yeah.
So certainly worth the Klaviyo multiple. And again, now you're going to send me the company and say, "Where's the term sheet?" But
No. Well, they have 10 years of runways, but maybe. But I'm
answering it. So I'm kind of answering it in kind of a pretty macro.
It's a good
way,
answer.
Which is like if you have those net retention characteristics in a big TAM, there's a lot of ifs which I don't know the answers to. What I would say is that deals will get done at even north of that multiple for a high quality company that has a lot of runway in a big market. I don't think investors are going to assume that everything's going to trade for 6 times revenue till the end of time. Now, I don't think people are going to also assume they're going to trade at 17 times revenue anymore, right? So you have to have some rationality to what you can assume from a exit standpoint. But at some point, the real question, Jason, is how long is the 50% growth compounding for? And if you're comfortable that it's compound, because my guess is I don't know the Klaviyo business, so I can't tell you what they're. But in year 5, is it compounding at 50 or is it compounding at 20? Because if it's compounding at 20, then maybe 8's not a crazy multiple. If it's compounding at 50, it's really undervalued. I don't know the answer. I haven't studied it.
It's a good answer.
Okay, we're gonna do a bet. Me and Jason love a bet, and now Jason. If you have a bet suggestion, then I'm happy to take it. The two that I'm kind of interested in is like over and under, and we can choose the company on ARM or Klaviyo. None of us are investors in any, so we're good.
Yeah, is the question which one do I own? I own Klaviyo.
No. The question is Klaviyo in a year, will it be over 15 billion market cap or under?
15.
From 9 to, well, let's do stock price just because market cap can be, there's like 88 calculations for market caps, aren't there? Enterprise value with you got the growth guys know better, but it's 36 today. So you're asking, will it be plus 50% in a year? Is that the bet?
Yeah, that's it. So it's going to be, what is that? That's 51?
Yeah, but like, see, like the underlying, like the question to me is what should be the underlying return in growth, right? Like that's really the question. The company's public. In theory, their growth rate, unless the market really inefficiently priced them, should kind of compound it kind of where the market compounds. And I don't have differentiated knowledge to say it should compound less or more because I haven't studied it, just to be honest. But I'm probably not going into any company assuming that I have a 50% IRR. Like I'm just not going to, like I would have to really know something specific that would make me feel like there's something I know the market doesn't know that would make me have conviction that something was going to have a 50% IRR. I don't know anything. That doesn't mean it won't, but since I don't know anything, I'm going to assume that it won't have a 50% return because I'm not going to assume the public market is going to have a 50% return.
Woody?
I'm not a stock market, picker.
Nor am I.
The way that I would think about it is if the companies execute, like I think there's probably more upside in some of the multiples than downside. That would be one of the ways that I would think about it. It's going to be about execution, but I don't necessarily look at the, some of the multiples in, certainly with some of the newly public guys. I don't think they're, remarkably overheated.
Okay, here's my bet. Let me simplify it. Maybe there aren't any takers. I'll bet 10 grand to anyone that takes it that Klaviyo 12 months from when this episode goes out or today, whatever Harry says, trades at 20% or higher from where it is today. I'll bet 10 grand it's 20% or higher. I'm going to take Devin's point about Matt. I can't everything.
I wouldn't bet against that.
You won't take that.
I wouldn't bet against that either.
10 grand?
Yeah.
I bet 10 grand that it'll trade 40% more.
40? Oh, you're pretty bullish, Harry.
My investment committee on personal...
We're all on the same side of this bet is the problem.
My investment committee on personal bets is my wife, and she would not allow me to take any such $10,000 bet, so I'm not going to take a bet. But I'm certainly comfortable with the 20% assumption, not 40. I don't think.
Okay, we're all betting. How about a grand for charity? We could do. We're all betting. Who's going to pay the other side? We're all betting. We're all betting Klaviyo is going to be 20% or higher. We're all hoping. We're all optimistic. 20% or higher in 12 months. Right?
Okay, let me throw one more out there. Where's that? It's at 57 billion now. I
have to be honest. I do not follow that market.
It's not even growing, is it? Isn't it shrinking?
I really have no opinion, just to be honest. The only thing is that you have one thing, which is you have a massive shortage of chips generally, and there's massive demand because of what's going on in AI. And ARM and everybody else are trying to come up with some way to position their chips for that market. I have zero knowledge of whether or not that's possible or not. So I'm going to not make any bet or assumption on this one.
And remember, all these things, it may not be fundamentals they trade off of. It may be the fact that very little liquidity is out there. And if people are trying to get liquid that have been long-term investors, ARM is very closely held. That could impact, the stock price more than anything else.
I'm glad we're all on the same side of Klaviyo. Deven, I'm glad that your wife rules the roost.
She does.
Guys, listen, I've loved doing this. Thank you so much for being so accommodating. It's been fantastic.